Okay, so this is again episode 2 of the Billionaire's Playbook to Financial Breakthrough, the podcast series where we're going over the process that I used to get to financial freedom and then in 2024 to boost my passive income by 50%, triple our assets under management. But till a few years ago, a new year would come, I'd have this resolution, this is going to be my breakthrough year. Nothing really moved that much. That's because something really shifted for me to take massive action. And so in this podcast series, we talked about Ray Dalio, who is the founder of the world's largest $196 billion hedge fund, his holy grail of investing. Right? That is the principle I also used. It's about having to really invest right. You need to have multiple non-correlated assets in your portfolio. And what that does is it reduces risk while maintaining or increasing your returns, right? Can reduce risk by 80% if you had 8 to 12 non-correlated assets in your portfolio. But so we talked about the holy grail of investing. We talked about the 7-step process that you can use to implement this process and make this the year you take massive action. So there's 7 steps, and it's very important to follow all of those steps, and we covered all of that in part 1. This episode, we're going to talk about one of the levers you can use to gain momentum, which is tax reduction. I will be giving examples of physicians in our community who've used that, how I've used it. The next 2 episodes, we will have case studies of physicians, just like you were using the same principle, who are using these levers to grow their passive income and shelter their income from taxes. The goal of helping you make this the year that it's your breakthrough financial year, right? And you really massively increase your passive income. And as when it comes to tax reduction, again, till 4 years ago, I was paying multiple 6 figures in taxes. Most of you probably still do. I know what it feels like. But the easiest dollar you earn is the dollar you keep in your pocket. We're going back to step 6 of the 7-step process. We're going to talk about leverage. That's what all these tax sheltering strategies can do for you. And so the way I'm going to break it down is that given where we are in terms of the election cycle, the new president, what we're going to do is we're going to talk about how 2025 and 2026 are going to be critical years for you to tap into these strategies and what we can expect in terms of changes to the tax code with Trump administration. What I'm also going to do is I'm going to break it down into how it affects passive investors. If you're investing passively in real estate, in syndications, passively in long-term rentals, how does this affect your strategy? And we'll also talk about active real estate investing strategies, right? This is for those of you who are thinking short-term rentals and real estate professional status. And when you're thinking about sheltering hundreds of thousands of dollars of clinical income from taxes, we'll talk about how people are doing this and what you need to be thinking about if those are your strategies for 2025 and the next few years. I'm going to break it down into what is best case scenario, what can we expect to happen? And then if we don't see massive changes, how are we still pivoting? And we'll break it down for both passive and active investors. So let's get started. I am super excited about this episode.
Welcome to Generational Wealth MD's podcast on financial freedom through investing in real estate. My name is Param Balathandapani. I'm a mom, radiologist, real estate investor, and mentor to others looking to start or scale their real estate portfolios. The goal of this podcast is to provide you with inspiration, strategies, and insight so that you can stop trading your time for money and live life on your terms. If you love the episode, don't forget to subscribe and leave a review.
We'll start off by talking about tax strategies in general, right? How does it affect real estate investors? And then I'm going to talk about what happened with the Tax Cut and Jobs Act in 2017, what is happening with sunsetting right now, and what we anticipate in terms of shifts with the current administration. And then once we're done with that, I'm going to again go over passive investors, what should you be doing, and how can you pivot and what to expect. And then active investors, for those of you thinking, okay, I hear all these stories about physicians getting into short-term rentals and sheltering hundreds of thousands of dollars of clinical income from taxes. Okay, that's what I'm thinking about doing. What do I need to do in 2025 and beyond? What happens if there are no changes to the tax code, and what can I expect and how can I prepare for it? Okay, so starting off with tax strategies for real estate investors. I think Robert Kiyosaki really explained this well if you've looked at the cash flow quadrant. And this is time and again, this is what we see, right? If you're an employee, a W-2 employee, or you're self-employed, right? You're on the left-hand side of the quadrant, and you really don't get to benefit a lot from tax incentives that are typically offered to business owners and real estate investors, the people on the right side of the cash flow quadrant, right? And so when you are a business owner or a real estate investor, and the advantage to real estate investors is that you get all of the deductions that business owners get, and you get to take deductions, depreciation deductions that are unique to real estate investors, right? And so you are essentially a super taxpayer, right? So if you're a W-2 employee like I was, and you're in the E, you know, the on the left-hand side of the cash flow quadrant, you're really paying taxes on all of your income, and then you get to spend your money. Okay, painful when you know that there's an alternative where super taxpayers who are business owners and real estate investors, what they get to do is they take their income, okay, they take all of their expenses off of their income, and then they pay taxes on the remainder, right? So what do these super taxpayers, what do these business owners and real estate investors get in terms of deductions? And I like to say that, you know, we had the SALT cap for personal property taxes in 2017. For those of you who are tax nerds like me, and you did your taxes and you were able to itemize a lot, and if you lived in California and New York, you know how painful that was, right? But real estate investors, right, you get to take all of the expenses on your property, including property taxes, mortgage interest deductions. You get to take all of that as an expense, right? So all of your expenses related to your property, all of the expenses that you incur as a business owner, right? Those deductions could be, home office expenses, meals and entertainment, travel costs. Even if you are going to a place where you have a property and you're traveling and you have some vacation time in there, as long as you structure it the right way, you may be able to write off the cost of travel. If you have a car that is used primarily greater than 50% for business use, even as a real estate investor, you get to use those deductions, right? So that's a tax deduction. Income shifting, that's something that's major. If you have children that you employ in your real estate business or in any other business, you get to you get to pay them through the business, or as a real estate investor, you get to pay them for working in your business. You don't pay marginal taxes, and all that money goes to them. And if it's, up to a certain amount, they have standard deduction, so they don't have to pay taxes on it either. So, right. So it's growing tax free and they get to use that. So a lot of deductions that are available to real estate owners, those are all tax incentives that you get being a real estate investor, right? So that is afforded to business owners, it's afforded to real estate investors. But I would say the biggest advantage, right, that real estate investors get, and these are the tax strategies you hear about all the time, is depreciation, where when you buy a property, you get a paper loss, right, a phantom loss that you're able to take year over year that allows you to shelter your income from taxes. Now, depending on the strategies you use, you can use this to shelter your passive income from taxes, which means if you have any cash flow from your real estate investments, this is for people who invest in syndications, right? If you have the money that hits your bank account every month if you invest in syndications, that is tax-free. Right? We don't think about taxes a lot, but living in California, my marginal taxes are over 50%, which means that if I made extra income as a physician, I would be paying over 50% in taxes, but all of my investments from real estate are tax-free, right? So depreciation protects my cash flow from taxes. If I were to go in, if I purchased a property and it increased in value over time, I can go in and tap into that capital tax-free. And I've done this multiple times, right? If you have even if it's a passive long-term rental, and my first property was 150K when I purchased it, it then went up to 250K, and I went in and I pulled out that money by doing a cash out refinance, completely tax-free. This is what the uber wealthy do, right? So something called step up in basis. When my heirs inherit my real estate portfolio, all of the depreciation I've taken, all of the gains, right? If it went from $1 million to $10 million, they would have a step up in basis. So no one's paying capital gains on all of that, right? So step up in basis, this is another tax advantage that real estate investors have. But I think the most powerful one is bonus depreciation, which is something we've seen since 2017. I'm going to talk about that in a little bit. And that's when you're able to take a lot of those depreciation losses up front in the year that you acquire the property. And so now you have hundreds of thousands of dollars. So we have physicians in our coaching program, who acquire $1 million short-term rentals, and they're able to bonus depreciate those properties and shelter hundreds of thousands of dollars of clinical income from taxes, right? And if you are a passive investor, you're able to shelter, the same amount of passive income from taxes. If you are a short-term owner and you materially participate, or if you or your spouse qualifies as a real estate professional, nothing to do with your real estate license, but if you qualify as a real estate professional, or if you hit material participation on your short-term rentals, which is what a lot of our community, our students in the coaching program are able to do, then we have physicians who've been able to shelter over $500,000 of their clinical income from taxes in a given year because of using these strategies, right? That is the power of what we call bonus depreciation. And I'm going to go into that a little bit, but that was what happened in 2017 when President Trump made changes to the tax code, and we had the Tax Cut and Jobs Act come into effect, right? And so that's what you hear a lot when you hear about physicians sheltering hundreds of thousands of dollars of clinical income from taxes. All of that stemmed from 100% bonus depreciation that came into effect in 2017 after the Tax Cut and Jobs Act. Those changes were made to the tax code. But before that, remember, if you are a physician who is thinking about really tapping into these same strategies to grow your portfolio, to really shelter your income from taxes, that be active or passive, then I know that I did a brief overview of what those strategies are. We have a 3-day in-depth event where we go over these very same strategies, all the way from acquiring, starting your portfolio, scaling your portfolio if that's what you're looking to do, to eventually, how are physicians able to shelter hundreds of thousands of dollars of clinical income from taxes? That's what we do in our 10x Your Financial Freedom event that we're hosting in March. If you haven't signed up, it's generationalwealthmd.com/event in lowercase. Make sure you sign up. We have physicians who are short-term rental owners. We have physicians who are general partners and acquiring, 200, 300 unit apartment complexes, who are going to be coming and talking to you at the event. I'm going to be talking about our 10x, 10x your income blueprint that so hundreds of physicians have used to really scale their income. So make sure you sign up. Now, that being said, let's talk now about the Tax Cut and Jobs Act. What happened in 2017? What is happening with sunsetting, right? So if no changes are made to the Tax Cut and Jobs Act, then we anticipate sunsetting to happen over time. So what does that mean? And then what changes can we expect from the Trump administration this time around? What is in the pipeline? Okay, so let's start off with 2017, right? 2017, the Tax Cut and Jobs Act came into effect. And honestly, it benefited business owners. It benefited real estate investors massively because we had bonus depreciation at that point. And I would say the people who were penalized in some ways were what we called Henry, right? High earners, not rich yet, which is where most physicians fall. And so what happened back then? To someone who was a W-2 employee, the only really impactful changes were SALT deduction limits, right? So state and local taxes deductions, they put a cap on it at $10,000. And if you were actually hands-on in terms of filing your taxes, I remember before that, as someone who lived in California, this is true for someone who lived in New York and places with expensive properties where we paid high property taxes and high state taxes, there was a significant drop in what we were able to itemize, right? Our personal deductions, itemized deductions were capped. And so you could only deduct $10,000 in state and local taxes, including residential property tax, right? This does not apply to rental properties, right? Business owners, the Tax Cut and Jobs Act was very favorable for real estate investors, but for residential property tax, there was a cap, and that was $10,000, and that was a huge hit because you were forced to use standard deductions. Standard deductions were increased, and that did benefit some people. And personal taxes were lowered from 39.6 to 37%, but that's about it for W-2 owners. For W-2 earners, what happened to business owners and real estate investors? how did it affect them? That's when, we had reduced corporate tax rates, qualified business income. The 20% qualified business income was something that business owners could use. There were higher estate tax exemptions. But the thing that had the biggest impact on real estate investors, passive and active, because we were able to use this for syndications. Physicians were able to use bonus depreciation on long-term rentals and use it to shelter passive income if they had passive income through their practices, right? And so we had 100% bonus depreciation, right? And what that meant is that, again, like I said, there were physicians who invested in short-term rentals, people who qualified, physicians or their spouses, if one of them qualified as a real estate professional, and for a short-term rental owner, you could be working full-time in medicine. We've had physicians, both of them working full-time in medicine, who, as long as you hit material participation, and there are multiple criteria to hit material participation, but it's very doable even if you have a two-physician household, both of whom are working full-time. They were able to purchase, like Shweta and Kishore, who were at the last 10X event, they purchased 2 short-term rentals and they were able to shelter $800,000 of clinical income from taxes, even though they were both working full-time, raising 3 kids, running their own practices, right? So that was possible because we had 100% bonus depreciation. Actually, they did it when it started phasing out, but they were still able to have such a huge impact. We had physician Sumana Mool, Dr. Sumana Mool, who spoke at the last 10X event, acquired medical office buildings, and she was able to, again, because of bonus depreciation, shelter $800,000 of clinical income from taxes, right? So bonus depreciation was huge. This helped, both passive investors and active investors, but that started off in September 2017, end of 2022. That was the last year we could use 100% bonus depreciation. The way the tax code stands now, bonus depreciation is phasing out, which means 2023, we had 80% bonus depreciation. Last year, we had 60% bonus depreciation. And this year, 2025, if no changes are made to the tax code, we are phasing out. We still have 40% bonus depreciation, right? And so we would have 20% next year, and then 2027, we would not have bonus depreciation anymore. So that's the way the tax code stands now, if nothing shifts, right? And so this is why I'm saying, if there are those of you who've been on the sidelines and you're thinking about getting into the short-term rental space, you really want to tap into these strategies to shelter your income from taxes before the tax code starts phasing out, then definitely make sure you sign up for the 3-day event. We're really going to be going into detail. I'll really be explaining these strategies. You'll be hearing from physicians, including one of our coaches, Samya, who self-manages a portfolio of 10 short-term rentals, and she does this without property managers, and she's been really able to tap into the strategy. She's technically exceeded her clinical income. Her income from her short-term rentals exceeds her clinical income, the income she makes in medicine, but she also uses these tax strategies to reduce her clinical income to shelter her clinical income from taxes, right? So super powerful. That's generationalwealthmd.com/event. But let's look at what, that's the sunsetting that we anticipate, right? And that's going to happen to a lot of the changes that were made with the Tax Cut and Jobs Act, right? A lot of them are, those provisions are expected to really, sunsetting is expected over the next few years if no changes are made. Now, with the Trump administration, though, the plan is to extend a lot of those provisions that would otherwise sunset. And so opportunity zones, this was a program that was meant to revitalize, areas that were economically distressed, and about $75 billion in investments has gone into opportunity zones since 2017. For anyone with a large capital gains, and this really pertains more to people who have large capital gains from selling stocks. And you can defer having to pay taxes on those gains by investing in opportunity zones. And I would say it really doesn't apply as much to real estate investors because we've always had 1031 exchanges where you can exit one property, and as long as you are using a 1031 facilitator and entering into the next property without the equity touching your hands, you are able to defer taxes anyways, right? So 1031 exchanges have always existed. For real estate investors, opportunity zones were more for people with massive capital gains from stocks And again, there may be an extension of opportunity zone, and that would require a change in the tax code as it stands today. So that is one thing that would potentially change. I think the biggest one that real estate investors are looking at is what is going to happen to bonus depreciation. We are at 40% bonus depreciation this year. Are we going to go back to 100% bonus depreciation? And I think, the goal of the Trump administration is to really fast track getting us back to 100% bonus depreciation. And if it does come back, they may even make it retroactive, which means if you acquired a short-term rental in last year with 60% bonus depreciation, then you may be able to, and you've already filed your taxes, you may be able to go and, amend that and really, bonus depreciate the rest of it. So we may get 100% bonus depreciation back. It may potentially be retroactive. Again, this is just in the pipeline, but they are trying to fast track it by passing this as a budget reconciliation bill, which is faster to pass. And so, potentially it could come back. But again, remember, none of this is 100%. But if it does come back, and we'll talk a little bit more about that, and I always say, look at it as an investor from the perspective of what if this doesn't happen and what if this does happen. And as we move along, I'm going to talk about, passive investors. How do you strategize around what we have right now currently, 40% bonus depreciation, and the sunsetting that's planned? And what do you do if, how are you going to pivot if 100% bonus depreciation comes back? We'll talk about the same thing for active investors after that, in terms of, okay, how do we strategize around it if no changes are made to the tax code? And what can we do if we get 100% bonus depreciation back? So we'll talk about that, but that is going to be a big, something that all real estate investors are looking forward to. But again, we'll have to wait and see. Now, other things that have been proposed to the tax code, changes to the tax code, are not having taxes on tips, overtime, or social security. And again, a lot of debate around that in terms of how that will impact people potentially who have businesses. How are they going to categorize what is considered tips, what is considered overtime? There is a lot of discussion over there, but we'll have to wait and see. Again, car loan interest, may become deductible. There is potentially going to be defunding of the IRS in terms of the large budget that they were presented. SALT cap that we talked about, that was capped at 10,000, could potentially be increased. We may solar and EV tax credits may be leaving. But all of that being said, I think the biggest one for real estate investors is going to be what is going to happen to bonus depreciation. And like I said, because these are all proposals, what we're going to do is we're going to take both scenarios and say, how are we going to create our strategy if 100% bonus depreciation comes back, and what can we do if there are no changes to the tax code? So let's start off with passive investors, right? And I know that in our community, the bulk of our real estate investors are passive. They invest passively in syndications or maybe investing in long-term rentals. The bulk of my portfolio at this point is also, my personal portfolio is also passive. And like I said, again, as a passive investor, you still get tax-free cash flow, right? The cash flow hitting your bank account every month. We just sent out our distributions for our fund. And so that should be hitting. So all of those monthly distributions will be tax-free. That will continue to be tax-free even if bonus depreciation phases out, right? And I mean, we have 40% bonus depreciation this year, but in the future, if it phases out, you will still all your tax flow will still continue to be tax-free. And that is because we will still have straight line depreciation. We won't have bonus depreciation. We will have straight line depreciation. So your tax free cash flow in real estate will continue. And that just means that if I'm making additional income, if I go in and make $1,000 working in medicine, working overtime, or taking call, I will be paying in California over 50% in taxes. But if I get that from a distribution from a syndication, that is going to be tax-free because of depreciation, right? So that will continue irrespective of what happens with bonus depreciation. The equity that I get in my properties that I'm able to tap into, so if I have a long-term rental, like in that example that I mentioned, and if I can go in and do a cash out refinance and tap into the equity I'm building in those properties because of market appreciation, because I have rehabbed them and increased their values, that's forcing appreciation, and because of debt pay down, which is where my Tenants are paying down a portion of the principal every time that I use the rent to pay down the mortgage, right? All those ways that my equity in the property increases. If the property was worth 150K and today it's worth 250K, those three ways of equity increase happening. And if this is confusing, guys, this is why I said join the event. We just break this down further. But all of the equity in my properties that I can tap into tax-free, I can continue to do, right?
If you're interested in learning how to invest in long-term and short-term rentals the right way, so you can accelerate to financial independence with the support of mentorship, community, and vetted investor agents in strong markets across the country, then get on the waitlist for the next cohort of Creating Generational Freedom at www.generationalwealthmd.com. You don't have to learn from decades of costly mistakes by yourself. The program is only open for enrollment in the spring and fall each year. In the last 6 months alone, our members have acquired over $60 million of real estate, and more importantly, they're living life and practicing medicine on their terms. You don't have to do it alone.
With bonus depreciation, for our syndication investors and for our long-term rental, our passive investors, you have been able to get massive losses, right? So those of you who've invested in syndications with us in the last few years, for a 100K investment, you've gotten anywhere from 40 to 60K in passive losses, right? So that will continue this year at 40% because we still have 40% bonus depreciation. So you will still get significant losses that you can use, and so that gives you time value of money, right? When you're sheltering either your passive income or your clinical income from taxes today, then that gives you time value of money. So that's always beneficial. So you will continue to have 40% bonus depreciation this year. So it's going to be a smaller amount than previously. And so you can use that to shelter your passive income, including income you get from your practice. We have a lot of physicians who have passive income from endoscopy centers, from a med spa, from a dialysis center. So if you get passive income from your ownership interest in the business, then you can use bonus depreciation losses from your passive investments, including syndications, right, to offset having to pay taxes on your passive income. We'll talk about people who are short-term rental owners and who have real estate professional status later on. But you can continue to do that this year because you have 40% bonus depreciation. Now, also there's something called lazy 1031, which is, when we had 100% bonus depreciation, whenever we have bonus depreciation and we have massive losses in that calendar year because we, were able to bonus depreciate our properties. So if you invest in a syndication and you get 100K, you invest 100K and you get 50K in losses from that syndication. If you are exiting another syndication and you have capital gains, you can use your syndication, the losses you get from one syndication against the capital gains that you have from another syndication. So you may be able to exit that syndication and enter a new syndication within that same calendar year without having to do a 1031 exchange. That's what we call a lazy 1031, right? And so if you remember from 2018 to 2023, no one really talked about 1031ing syndication exits, right? So if you exited a syndication, no one really talked about, let's 1031 it into the next deal because you were able to do what we call a lazy 1031. That's because of bonus depreciation, right? So if bonus depreciation comes back, you will still have the ability to shelter massive amounts of passive income from taxes, and you'll still be able to do lazy 1031s. You can exit one syndication, get into the other syndication. That's what happens if 100% bonus depreciation comes back, or we continue to have, a significant amount of bonus depreciation. You can do it this year because we still have 40% bonus depreciation, and you may be able to continue to do it if the tax code changes. Now, what happens if the tax code does not change? All right, how do I reduce my, the impact on my portfolio from taxes, right? And so again, like I said, your cash flow will continue to be tax-free. But these massive losses that we were able to get in year one, we won't get the same amount, but we can still do what we call accelerated depreciation, where you will get a little more than straight line depreciation upfront. So you will get we're not going to get the large amounts of depreciation we have today. We would go back to strategies that we had pre-2017, where people used accelerated depreciation, right, to try to really move forward some of those depreciation losses and use them up front. So you will still have some losses. And then when you have an exit from a syndication or you are selling a long-term rental, you will not be able to do a lazy 1031. What you will have to do is a traditional 1031. Now, again, this is where you need to talk to your sponsors and look at the language and syndications. If you own your own properties, then you have the ability to do a traditional 1031, and that's one way to offset capital gains taxes. When you're exiting deals and depreciation recapture, right? So you're offsetting both of those things. So there will still be strategies that you can tap into. That's going to be a 1031, and then 1031 exchange is potential what you're going to be tapping into. A traditional 1031 exchange, you may not be able to do a lazy 1031, but your tax flow, your cash flow from your passive investments will still continue to be tax-free because of straight line depreciation. You may be able to accelerate depreciation, which is where, the first 5 years, five-year property, whatever's considered to have useful life of 5 years, the IRS will allow you to depreciate that in the first 5 years of ownership, right? So you can use straight line depreciation, accelerate depreciation, you can use 1031 exchanges like we did before 2018. Okay, so that's for passive investors. Now let's move on to active investors, right? So let's talk about those of you who are considering short-term rentals. You want to materially participate in it. You can still do that. And this is why the short-term rental strategy is a little more powerful than real estate professional, because if you are two physicians who are both working full-time, you can still tap into this strategy as long as you're hitting criteria for material participation. And both spouses can combine their hours to hit material participation. There are 7 criteria to meet. You have to meet just one of those criteria to hit material participation. The one that most physicians hit is 100 hours. In that calendar year that you spend on your property and more than anyone else, right? That's what most people hit. They can still do it while holding full-time jobs. The advantage, there are so many physicians who use 10% down loan products to get their short-term rentals out of state. They manage them without property managers. And so if you're interested in learning more, definitely join the 3-day event. We'll deep dive more into these strategies. And there are so many physicians who use syndication losses to offset the income from their short-term rentals if they, in following subsequent years where they are passive in their STRs, right? So multiple strategies over there. So what are you going to do as far as that is concerned if bonus depreciation is phasing out, right? And I think the first thing over there is that if bonus depreciation is phasing out, remember, if you're really trying to tap into this and you're really trying to scale your portfolio based on these strategies, then make sure you hunker down and acquire something this year, because we still have 40% bonus depreciation, right? So this will be the year to do it. And we'll talk a little bit more about, what happens if it does get extended, if it doesn't. Let's talk a little bit about real estate professional status. Now, again, the second strategy that physicians use to reduce their clinical income from taxes is real estate professional status. Again, for this, one spouse, you either have to be working part-time or your spouse has to be part-time or working less than part-time for you to be able to tap into the strategy, because for one of you, the one who qualifies as a real estate professional, you need to meet criteria where you're spending the majority of your time producing income in real estate, and you are spending at least 750 hours in real estate in a given calendar year. Now, in addition to that, you need to materially participate on your property. But when you meet those criteria, you may be able to shelter up to $626,000 of clinical income from taxes in that calendar year. And the same number applies to those of you who are considering investing in short-term rentals, right? So this is where the strategy becomes really powerful, right? So this is where you hear physicians investing in short-term rentals, physicians who qualify as real estate professionals, where they're able to shelter hundreds of thousands of dollars of clinical income from taxes. We see physicians, like I mentioned, Sumana, physicians who own medical office buildings also able to do this. There you have to be careful in terms of, the year that you're acquiring the property and the way that you're attaching that to your clinical practice. So you want to make sure you talk to your CPA and have that conversation to make sure that your taxes are being filed correctly the first year, so that you're able to really use the depreciation losses from your medical office building to shelter your clinical income from taxes. But those are the three strategies that physicians typically use. And then that has been supercharged because of bonus depreciation, because now they're able to, in the first year, get these huge losses that they can use to shelter their clinical income from taxes. Now, this also meant that if you sold a short-term rental, you didn't have to do a 1031. You were able to just acquire another property within the same calendar year and do a lazy 1031. Now, what happens if bonus depreciation gets extended? Then that's amazing, but it could potentially become retroactive, which means you may be able to get larger, go back to where physicians could buy a property worth $1 million and get close to $250,000 to $300,000 of their W-2 income sheltered from taxes, right? Which is massive. We would go back to those numbers as opposed to only being able to do 40% bonus depreciation this year if the tax code doesn't change, right? So if it goes back, that'd be amazing. It could potentially be retroactive. Now, if that does not happen, what are your options, right? So you still have 40% bonus depreciation this year. Like I said, like passive investors, you can still do accelerated depreciation with your short-term rentals if you are a real estate professional and if you own medical office buildings, and you can use those accelerated losses. It's not going to be as great as bonus depreciation, but accelerated depreciation still allows you to take 5-year property and depreciate all of that in the first 5 years. It allows you to take 15-year property and depreciate it in the first 15 years of ownership, right? So it's still better than straight line depreciation, but you're still able to use some of that. And then you would again be forced to do a traditional 1031, which again is what people have been doing for decades, right? Do a traditional 1031. You can offset having to pay capital gains taxes. If you are, if you're selling a property, you can offset capital gains and depreciation recapture by doing a traditional 1031. And then again, like before, your income, your cash flow from your properties would still be tax-free because of depreciation. So again, like I said, if this is a little confusing, make sure you join the 3-day event. There is so much we can talk about in terms of tax strategies, where how do you meet criteria for real estate professional status? So how are physicians doing this out of state? How are they doing this without a property manager? What are the strategies they're using? What's the software they're using? How much time do they actually spend? Typically, if you're spending more than 2 to 3 hours a week on your short-term rental, once you've automated it, then something's off. We should be titrating it, right? So come and listen to the speakers and see what they have to say. But I think I want to leave you, like we talked a lot about what happened in 2017, what's happening with sunsetting of the Tax Cut and Jobs Act, what happens if it gets extended, and if you are a passive investor or you are an active investor. We talked about okay, if bonus depreciation comes back, what are we going to be doing? And if it does not come back, what are the things that we can fall back on as real estate investors to still make sure that we're tax efficient from, in terms of our cash flow, in terms of the equity that we're able to pull out, and also to make sure that if we are selling and buying something else, that we are being tax efficient as far as capital gains and depreciation recapture, because ideally you want to be deferring, not having to pay those taxes. So it's like swap till you drop. That's the 1031 exchange, right? Keep swapping your properties till you drop, and which means till you drop dead without being morbid. And at that point, there is a step up in basis and your heirs inherit the property, and all of those capital gains and depreciation is wiped off, right? So that's the goal. So again, real estate investing has always been very, very tax efficient. It will continue to do so either way. But there is a high likelihood that bonus depreciation, 100% bonus depreciation, may get reinstated, and that it will be retroactive. So we'll have to wait and watch. But I want to leave you with one saying that I think is going to be very, very critical. I think the most important thing to remember is that you do not want to let the tax tail wag the dog. And that's really, really important, because what you get in terms of tax savings, it shouldn't affect your strategy, and it shouldn't affect your drive to invest in real estate. And that's because, if I owned a property for 10 years and I, was able to tap into real estate professional status or the short-term rental strategy upfront, and I got $100,000 of in tax refund, which a lot of our coaching clients get back, right? When it's tax time, which is now. So we're getting all those messages. Param, I got a 100K tax refund. This is amazing. I did the impossible, right? So we hear that a lot. But I think the important thing to remember is that is just a piece of the puzzle. It's amazing when we're able to do that, because now we're able to really accelerate. That is a lever for momentum that we love to tap into. But over the course of 10 years, if you buy right, that property could potentially give you $1 million in returns once you factor in appreciation, your cash flow, debt pay down, forcing appreciation, and inflation hedge, right? Because your cash flow is increasing over time, your property value is increasing over time, right? There's so much happening. And so it's just a small fraction of the benefits of investing in real estate. So do not let the tax tail wag the dog. And with that being said, again, I highly recommend anyone listening who is looking to start or scale, or if you're even thinking, I want to become a general partner, I want to listen to other physicians who have, gone down these paths, then make sure you join the 3-day live event happening in March. It's free, so you have no excuse to not join. It's generationalwealthmd.com/event, and I will see you there. Okay, guys, I'm going to hop off. If anyone thinks of anything, just drop the questions, and then I'll make sure I get to them. Okay, take care, everyone.